Hi everyone, this is Rob Roy of Elliott Wave Options, and welcome to TradeFinder Live. For those of you that have been here before, you know the background. If you're new, this is not the normal background. Actually, came up to the mountains for the holiday / my birthday weekend, and there was a time that I came up here over the winter time, and I got snowed in. Now it looks like I might get hurricaned in. As far as the travel plans getting back with the storm and everything, it's thrown all kind of travel plans into a flux. So by Thursday, if you're one of our alert subscribers, I'm sure I will be back. So we'll see how that plays out over the next couple of days. Tomorrow night, we have our live Q&A for the Strangle Mastery. Not able to make it back to Florida, then we'll be doing it here. So regardless, we will have the live Q&A Strangle Mastery class tomorrow. So if you're a new subscriber, then you're going to get an awful lot out of that, and we invite you to join. You'll have the recording as well, but if you can attend live, then you get an opportunity to ask questions and have your questions answered, obviously. All right, so with that, let's go ahead and move forward. If you are brand new, welcome. If you've seen any of our videos that we've done, any of the publications, you know we have to do this disclosure / disclaimer. It is important. So if you're brand new, please take a screenshot of it, read it in detail at your leisure. But a couple of things that the powers that be want us to make sure you're aware of is, number one, we are not registered to give individual investment advice in the United States. And number two, because we have a lot of international viewers and we have a lot of international alert subscribers as well, any pricing that we're talking about is assumed to be in US dollars unless noted otherwise. So those are the important things. But again, first time, take a screenshot of it, keep it, read it when you have an opportunity. How the TradeFinder works is we will go through a brief market update, pretty interesting Friday and Monday, or Tuesday, excuse me, with the holiday weekend. So we'll talk about that, where things are. As you saw, there was a big downward move through the middle of the day today and a rally towards the end. So we'll talk about that. Then we'll go through and look at any alerts that we have closed for the week. And then with time that we have left, we'll go through looking at our past case study considerations that we've identified during our TradeFinder events, and then look for one, at least for one this evening. The reason I say that is we were just doing one and we've kind of morphed that into a couple, but trying to keep it with one just to stay focused. And then we'll answer questions with in your remaining time at the end. And if you have a question, it usually amounts to you asking about your favorite stock and us taking a look at what our symbols show for your stock, or our indicators, I should say, show for your individual stock. So that's it. That's the process of how TradeFinder works. Again, if you're brand new, welcome, and let's go ahead and get into it. So the first thing we'll talk about is where the market is, and you can see two big bars, one on Friday, followed by another one today, and you notice the long tail on today's bar. So let's move the chart out just a bit and talk about this last little zigzag pattern that we've been focusing on here. There was the 426 level that was hit, and then we moved into this zigzag within a C wave of a zigzag, and that got us to 436, 437, and we almost got there. So now we're right back with the same thing that we've talked about before. We've even talked about this in the last SPY market update. If you haven't seen those, and they're on YouTube, I imagine you have. It's probably how you found out about TradeFinder, but those lines usually get touched. And we had this movement back here where we almost got to 426. You said, oh, that was pretty close. Same thing at 420. And then the lines got actually touched. And now we're talking about that once again with the high that occurred on Friday at 434. So pretty darn close, but still hasn't actually touched the line, which normally they do. Now, over the weekend, since it was a holiday weekend, and we do have a great website, if you haven't visited yet, EWOtrader.com, lots of good educational information in addition to information about all of our alerts, etc. You'll see it here in a minute. But just to tell you about another aspect is I can post commentary in between doing these webinars. So on Thursday nights, we do a webinar for just our alert subscribers only, where we go through and talk about all of our open alert positions, anything that we may have closed during the week, adjustments that were made, etc. And then they have an opportunity every week to ask live questions as well. Well, we're talking on Tuesday nights TradeFinder, Thursday nights Insider Meeting, but there's still a few trading days that we can communicate with if something of significance happens. And so I made a note to our subscribers over the weekend that when you looked at this bar that occurred on Friday, and let's put the moving averages on here, and you can see our 10-day moving average is the one in lime green there. Note that the high of the day on Friday that created a bit of separation from the 10-day moving average, and our subscribers have heard this so many times. No security in any time frame gets very far away from its 10-day moving average. And I made a note that we had broken above the 426 level that had acted as resistance for a while here. So we came here and we're struggling through this area. You can put that line right through there. So about a week we hovered there. And then I'd also commented, and you've probably heard that if you've been here before, that I felt like if we broke above that level, it wouldn't be just a drift. It would be a pretty significant move. There's a lot of stops that are placed there, and that the stops would be unwound, etc. And so that's what happened on Thursday and Friday, big boom, boom, vertical moves. And then the commentary was that, okay, we're overbought now. Now we have broken with a confirmation to the upside, but we also are overbought. So let that calm down, let the overbought condition resolve itself, which amounts to one of two things. So again, if you're newer, we talk about this a lot. When we get an overbought condition, either the stock goes sideways and allows that 10-day moving average to catch up to it, or the stock backs off and comes back down towards the 10-day moving average. Either one of those scenarios can occur, but as you look along this chart, even of the SPY, even of the market, how it hugs the 10-day moving average. And then if we get here, we got it a little bit too far below it. So that doesn't matter whether the separation is above or below. If it gets too far away, it has to come back to the 10-day moving average. So here, rallied back. Same thing here, rallied back, and you can see the process. So the commentary was, let's let this contain itself, and then we'll look at some more bullish positions, because clearly that was a break with confirmation. So there we go. There's today's bar, doing exactly what we thought was going to happen. Came down near the 10-day moving average. Thought it might even, the way it was looking at one point during the day, that we might actually come down and touch the 10-day moving average, but it didn't, and then we rallied back. We didn't make a new high today, so can't quite call that an outside bar day. But pretty darn close, and sideways days. So when you see stuff like this, you're going to want to look at the volume. And there was some almost average volume, better volume than on Thursday and Friday. So the question becomes, was that volume on the early part of the day when it was hard selling, or was that volume that stepped in when the market rallied off of the lows in the afternoon? Where was the volume? Probably a mix of both. Had it been above average volume, I would have likely said that that probably came in from the selling. But the fact that with selling as hard as it was in the beginning of the day and then the rally, and we still didn't even make it to break even, I don't think that was significant selling volume. I think the buyers just stepped away, said, let's see what happens, sensing that the market was a bit overbought following the rally at the end of the week. I don't think the sellers have come in and pressed the bets at all yet. And I have made this comment before. Some may view it as a bit of a conspiracy type theory. I don't really view it that way. I just feel that over the years, been doing this a very long time. Sellers, for the most part, are pretty smart. And the reason for that is because they take a tremendous amount of risk. And so if you're going to take that kind of risk, probably going to be a fairly smart trader. And they condition the buyers, especially now with COVID, people were staying home. There's a whole new generation of traders with all the Robinhood stuff and everything. A lot of people trading that have never traded before. And so the shorts, in my opinion, are setting them up. And they're programming buy the dip, buy the dip, buy the dip. And every time the market goes down, you can see the comments if you're on Twitter or whatever. They're saying that. We got to buy the dip. Market always goes up. Stuff that you just shake your head when you read, but it's exactly what the shorts want people to think about. And one of these days, we're going to have a downward move, and buy the dip isn't going to work. And that's when the sellers come in, and they make their year off of a very short-term scenario. It's just how it is, and happens over and over and over again. And I think they're licking their chops at the new breed of traders that have not experienced a down market before. Not just what happened last March. A lot of those traders hadn't even started yet. That's what, when the whole world shut down and people were at home and they started doing the day trading stuff, that's how they started to find out about the market. So it had already tanked and was just going straight up. So yeah, it was like easy, right? The market's going up every day. It doesn't work that way, as you know, if you've been around for any period of time at all. So my point here is that we corrected the overbought condition today. Do we need another sideways day tomorrow? That could happen. Or are we ready to try to move on up? We don't have very far to go to hit that next fib level. Then we start talking about that 261.8% level. And I've been hesitant to say that it's likely we go there. Obviously, it's a fib level because we show it, and therefore it must, work and have a target hit. This doesn't get hit very often, though. It has in the past, 9/11 on the downside, et cetera. There have been times of extremes when that 261.8% level has been hit. Maybe this is going to be one of them as well, but it's far less frequent than the 161.8, which we've already hit at the 426 level. So in 420, 426 were both 161.8% extension level. So all in that area. So that's where we are with the S&P. Let's take a look at Bitcoin. I know you're going to ask about it anyway. So let's go ahead and get that out of the way, the markets. And man, if this is just not doing exactly what we talked about, we're here last week, where this has morphed into, if you haven't seen this before, just as a reminder, we had this big zigzag to the downside. We actually talked about it during TradeFinder that breaking that 100%, we'd go to 161.8, which it did. And then we morphed into we started with a triangle, consolidating triangle, and that morphed into a descending triangle. So there was a little triangle initially. It was well formed though, so you had to pay attention to it. And then we got the false breakout to the downside, false breakout to the upside. Our subscribers know, based on our strangle strategy that we use in our volatility portfolio, that there's no such thing as two head fakes or two false breakouts. When that occurs, it means you're building a larger triangle. And so in this case, with Bitcoin, yeah, we're building a much larger triangle, and that's the descending triangle. Now, last week we talked about how, and in the recording, that we could go, sideways a little bit further because there was some room there towards the point. Well, we've kind of done that now, and I think that Bitcoin is going to make a pretty significant move in the not too distant future. When you have a descending triangle pattern, you don't pick a direction. No way to know whether it's going to be an upward move or a downward move. I just think it's going to be a significant move, one direction or the other. And so it's going to be interesting to see which way it goes. And we've talked about this before as well. You can clearly see the support down here at this 30,000. Let's just round it off, 30,000 here at the 161.8% level. And then we have the 100% extension level. That was an extension level to the downside. So when we're coming down, that's there. So you look at that as far as any potential resistance on the next break to the upside. And so, well, let's just round that to 40,000 and just say, hey, support on Bitcoin is at 30,000, resistance is at 40,000, and we're probably going to break one of those two based on the size of this descending triangle, which means we're either going to move down significantly or rally back significantly. But it's going to be fun to watch to see which direction it goes. And as I said, I don't think we're going to have to wait too much longer. And I know a lot of you like to look at the Qs, and that's had a pretty interesting chart lately. So let's go ahead and take a look at that and see how that traded out. And you can see that we had the break to the upside there on Friday as well. But look at today. Man, the chart on the Qs just looks pretty darn good. Nice wave 3 pattern. Tiny bit more vertical than 45 degrees, but not a whole lot. Right through there, I would say was great. We're starting to move a little bit away from that, which, maybe it comes back down. It's not that far off of it. It's not that vertical, just a little bit, just enough to notice basically. So then we really want to look at the DMI, and it just looks fantastic. I mean, it looked great last week. It looks great now. Looks like the Qs want to continue. So kind of goes along with the market moving higher from here. Hard to imagine the S&P moving to the downside with the Qs so strong. I mean, that's pretty powerful looking chart in that wave 3. Eventually we'll start the wave 4, but based on the DMI, one of our favorite confirming indicators for Elliott wave, doesn't look like it's going to happen in the near future. Well, then we bring in the CCI. Why do I look at that? It's far more responsive from a day-to-day aspect of the market, moving with the CCI. You look at historical pricing, because the scale over on the right, it's not the same for every stock. If you're not familiar with the CCI, we have an educational series on the website called Trade Scan, where we go through in detail each one of our technical indicators so that our subscribers understand when we're having our insiders meeting, et cetera, or when they're looking at the videos, what our alerts, when we're talking about the specific indicators, they have an awareness of what the indicators are and how they work. And I think that's really important. And so with the CCI, the scaling over here, it's not uniform for every stock. It changes. And in the end, it's not that meaningful other than just getting a rough idea of whether you're overbought or oversold. What's meaningful is you look at where is the CCI now versus where are the recent or historical peaks of overbought, oversold conditions. And so you can see where we are here, just going back to January, so this year. And even though it looks like at first blush the CCI is pretty high, it is in the higher end of the range, no doubt about that, but it's not at the extreme level yet. So it could go to the upside from here. It's my point, basically, without getting too far into extreme overbought scenarios. So, maybe there's a little bit more to come out of the Qs. Pretty amazing. And then if we take a look at the IWM small caps, a lot of you like that. Then we look at much different chart. It's just amazing to me, the difference between the three charts. The SPY is kind of in between the two, if you will. But the IWM, the small caps, doesn't look that good. Certainly doesn't look anywhere near as strong as the Qs chart does. So, what is that telling us? That the markets are all different. I think it goes back to money rotates, and it looks for homes, and it looks for places where things are potentially, hard to imagine anything being undervalued right now, but that's what the money seeks out. It doesn't really care where it is, at least not in this environment yet. If we start to get a corrective move, then it's going to go to defensive sectors, always does. But for now, it's just searching around for where the stocks that haven't followed as much of the rally as some of the others have. But here we are down here today on the Russell, and we go back to the SPY, and we basically finished, let's call it flat on the day, and then coming back to the Qs that just shook everything off today and powered forward. So depending on what you're looking at, everything is significantly different regarding those primary markets. I know we have a lot of international subscribers, and I wanted to go ahead and show this. I do it we have a lot of alert subscribers now from Australia. So started looking at the XJO, which is their ASX 200. Don't have as many issues in Australia, so shares, if you will. So their ASX 200 would be similar to our SPY or S&P 500 here in the US. And you can see what's happened here is that we're still creating this triangle following a pretty nice run up. Now, way back in January of last year, commented when we did our Elliott wave forecast going into 2020. So not this past January, but the January before, still on YouTube. You can look at it and see it. It was right there. And we went through, because the market was rallying then, right? What are some potential black swans? What things could derail the market? And one of the things we talked about was COVID, the virus. It was just in its infancy in China at the time, but it's just like there's noise, there's rumblings, and it just kind of felt like it's something to pay attention to. And boy, did that turn out to be prophetic. Just a couple months later, all you know what had broken loose in the markets as it began to spread like wildfire. What's my point? I ramble on and tell a lot of stories, but this new Delta variant, the media is having a field day with this. They talk about it like, hundreds of thousands of people are getting it every day. And in fact, in Florida, they said, the number of cases in Orange County, which is Orlando, doubled from the previous week. So from one week to the next, the cases doubled. But then when you get into it, it was 32 cases, from 16 or 14 or something the week before. So there's this glaring media making it sound like, it's infecting everybody. And it was 32 cases. Now, not to minimize those 32 people that got sick, but my point is the media is sensationalizing this. And I don't know, I just have that eerie feeling that this could be something. I don't think we go ever back into a lockdown. I think a lot of governments and countries have learned that maybe that wasn't the best thing to do, but I could see restrictions and going back to social distancing, things like that, back to mask mandates. And it's just something that could potentially be out there. So again, it's hard to say the same thing is another black swan because, it already happened. So I don't think that really meets the definition, but it just seems eerily similar to me, the way the media is sensationalizing this about how infectious this is and how deadly it is. And now it affects young people. And you've heard all the stuff about it. Well, the reason that I wanted to talk about that with the XJO is I was just reading last night where Sydney is considering going back down into kind of lockdown type procedures due to concerns about the Delta variant. And maybe some of our Aussie people can tell us what they've heard. And, maybe you have to believe what's in the media with a grain of salt at times, but that's what I read last night. And so who knows, does start something that could create a derailment to the market? And certainly nothing has stopped it so far. But boy, that is a really well-formed triangle. This is so classic Elliott wave on the ASX here with the wave 5 ending into a symmetrical triangle. That's exactly what happens with Elliott wave patterns. And if it is done, because it was an 84% extension, so it could go further, but if it is done, and you can see the lower volume in the consolidation of the triangle, which is what you would expect, since it wasn't a full 100% or more extension in the wave 5, you look for a potential move all the way back to the 4. That's a big move lower. What could cause that? Maybe what I just discussed. So again, I don't want to be someone that's spreading unfound rumors, etc. Just talking about things that could come back to become significant. It just kind of feels like they're making a really big deal out of this. Now, I don't know whether it is or not. I'm not a medical doctor nor in the medical profession, so I don't know the actual significance of it. But if the media sensationalizes it enough and we start having sanctions again or restrictions, I should say, who knows how that's going to affect the markets. So those are the things that I wanted to cover as far as the markets. Let's get into looking at some of our past case studies. Then we'll go in and look at a current one. We'll go ahead and bring up the trade register here and show you one of our, so you can see we have, wanted to highlight this one too. This isn't really a closed trade, but people really like this. So I thought I'd go ahead and use this one as an example. This week, let me blow this up for you. a little bit. This is, and it really garnered a lot of chatter when we talked about it before, and that's an out of the money butterfly. In this case, a long call out of the money butterfly. Now, butterfly is normally a sideways strategy. It's placed at the money. You expect the stock to stay in a trading range. That's how the strategy was designed. But the way we utilize it is we place it out of the money, so way above where the stock is trading now, but where the stock is expected to go. So the stock normally in an at the money butterfly has to stay in the trading range to generate a gain. If it goes out of the wings, then you start to lose money. So very important that it stays within those wings. Well, when you place it out of the money, the stock doesn't even have to make it to the wings. All it has to do is start moving in your direction and it starts to gain value. And so that's where it becomes a really great strategy as far as low risk, high potential reward. Now, the further it goes towards where your strikes are, the better. And if it moves within the wings, that's even better. The closer to expiration it moves in the wings, the better. And so you start to get to where you can get a really exponential potential gain in it if you were able to get the stock in between the wings somewhere in the area of expiration. So it starts off, we are long only. So our enemy is time decay with our portfolios, but we can hedge it the best we can. And one of the great ways to do it is with an out of the money butterfly. In other words, what I mean by long only, I mean the fact that we are buyers of options. So not short options. So not long only as far as trading to the upside. So let me clarify that. We trade whatever direction the market goes. Talking about long versus short as far as buying versus selling. We are buyers of options, and so time decay becomes an issue, and we hedge it with spreads when we have an expensive option position, or when we're able to place a out of the money butterfly. Well, this timed out really well with Google because the volatility had come back down. When volatility was high, it's not the greatest strategy because the last thing that you want is for it to just move to your target immediately. The more time goes, the more you can make. So this is one of those positions where you're okay if it kind of meanders around and takes its time. Normally, when you're a buyer of an option, you want it to get to its target or move immediately because the quicker it goes, the less time decay is involved. Well, then when you have something that's time decay neutral in the beginning and then becomes time decay friendly as time goes on, as you get closer to expiration, that time decay clock begins to move in your favor. So if it wants to take its time, great. Well, Google did kind of go sideways for a while. You can see the entry there was on June 24th. Now, we posted a comment here because the fact that it's on Google, when the market closes, and we have these graphs over here, which are mark-to-market graphs. And that shows you what every position is every single day. So we're as transparent as you can possibly be. And so the way this works is the spreads widen significantly in the evenings, in the after hours. So you can see it was causing kind of a whipsaw effect on the mark-to-market graph. It calmed down today, and that's exactly where the position is as we speak right now. So we're 12 days into the trade. It's made 52%, but if we take a look at the chart of Google, which we will here in a minute, it didn't do anything for up until basically the last 2 or 3 days. So I'll show you. So I went sideways and then just a little bit of movement because some time went by. That meant that when you did get the directional movement, all of a sudden you made money in a really fast pace. So already a 52% gain. The position's still on. It hasn't been closed out. I know we usually show closed positions here, but by the way, this is what our trade page looks like. Every single alert has a page exactly like this. So it's got a trade ID, it's got the name, you see the strategy, number of contracts, the strikes here. So it's a 28, 29, 3,000 out of the money call butterfly that we have, and 2 contracts, $2.40 to put a trade on Google. That's pretty amazing. And so there was the chart. You can see at the time that we put it on, it had just broken above some resistance that had occurred back above back in April, and it was holding there. So old resistance becomes new support. So it had broken above it and it was holding, and it just seemed like it was ready to go to the upside. It sat there for a while, but then it took off. So I'll show you the current chart of Google. But you can see there 52% already in the position, and we're nowhere near where the wings of the butterfly are. That's the main point that I wanted to make on this, is there's so much more profit to go here because of the fact that we're not even close to 2,800. So there's Google. We closed today at 25.23. So you put a position on. See, here's that additional sideways movement that I was talking about right here. The sideways stuff. So you have the sideways movement moving through here, and then you break out, and all of that sideways stuff, you have 2 up days. That's it. 2 up days, and the position's already up 52%. And the fact that the high of the day was 2,500 something, and our lower strike, remember, is at 2,800. So we're nowhere near the bottom strike. So the potential that you can make on these is really strong. So when the volatility goes down, we're able to do that along with our strangles. And so when the market moves, we have all positions covered, whether the market breaks to the upside or the downside. So if the market wants to move a little bit higher, then we're going to put on one of the best looking charts for the market to move higher. And that's what Google's doing. I still think that we're at a lot of resistance, and we put on a lot of strangles with the market going sideways there. But hey, the strangle makes money with an upward break too. It's not just a protective thing. One of the beauties of a strangle, though, is we have our impulse portfolio as well, which is directionally based. So when the market moves in a direction for a while and then changes directions, well, you go through a period where you have to, move your positions around from being bullish to bearish, etc. And that can take a little time to get things back in line. But hey, if the market breaks to the downside, the strangles have the long put. So they're already covered. So not only do you have the strangle being able to make money on a downward move, it also adds protection to the impulse portfolio for when we do go through a market change of direction, which so far it's been very short-lived on the downward moves, mostly been consolidating to the side, kind of like this chart with Google here. But at some point, the market is going to make a break. So I thought I would share that with you, something really interesting. So let's go back and look at our past case study considerations. So this is, we've crossed a bunch off that have already hit targets, and we're going to cross a couple more off tonight. So DBI was trading at 1879 back on May 4th. And then when you look at it now, it had moved to the upside, didn't quite make it to where I don't think anybody would have been tempted to take a profit. So now we're at a 33% wave 4 correction. So if you're still in, do you hang in there? Do you write this one off as a loss? I would be okay with anybody's sentiment. The 33% is kind of in no man's land. It may very well move a little bit lower and make it down towards the 38%. That's probably where it's going to find a bit of support. So you would have to hang in there for a little bit more to the downside. Maybe you want to do that. Maybe you don't. I think to the best of my memory, since we started TradeFinder, we only closed one position off that was an actual loser. This one might be number 2. So we'll see how that plays out on, what your feeling would be on that. Personal choice there. And that's the difference between these case study considerations that we look at right every Tuesday night and our alert subscriptions. Our alert subscriptions, we send out entries, any adjustments and exits, and updates like a market commentary every single week, going through every single alert. All those things go along with it. And then we had Poly Plantronics look like this on May 11th. And it broke to the downside pretty significantly, but not enough to where it was really a big enough game. This one had a lot of volatility already built into it. And so it's rallied back, and we were looking for an opportunity to take the calls off and hold the puts. We might be getting that opportunity here. So it came back, it filled the gap. Then it looked like, well, maybe this is going to break and run to the upside. But then it's come back down. So it looks like maybe the original plan was was in order there. So that one still looks good to continue to make its move. And then you can see the triangle here on MGA. So this will give you an idea on some of these triangle patterns if you're new to the strangle strategy. You can see there's the false breakout to the upside and a big move lower. And that one was to the point where we kind of looked for a 10% move out of these breakouts, a minimum 10%. The profit range is about 30 to 70% right in there. And so this came down from about 96, 97 down to 90, or it got a little bit below that, but not quite 10%. So saying, could kind of hang on, and then you can see another big down day to day. And you can see why this 90 level is so interesting. So in my opinion, you kind of want to give it a chance to break that level. If it breaks that level, we still got a gap way down here. It could get really interesting to the downside if it can't hold 90. So it held it the first time that it tried to break it. So we broke below it, closed below it, but no follow-through day. It's another thing our subscribers know. Got to have a second day, follow through a confirmation day to try to break a major point of support or resistance. It didn't have it. Now we're right back down there again. See if we get it this time. I just think it's worth kind of hanging in there on that one to see, hey, let's see if we can get that opportunity. And then we had SeaWorld, SEAS, and that was back on the 25th of May. Triangle pattern, another one, false breakout to the upside. Big move lower. Look at today's move to the downside. So almost identical charts to MGA and SeaWorld. So we're right back down, right near the lows. And another one that these are such similar charts. It's amazing. There you go. Another one you want to let us see. Can it break that level? Because if it does, it's like straight down. There's a gap there. This was a vertical move to the upside. You want to give it the opportunity to make that vertical move lower. So it's had a nice breakdown, and it's right around 10%. But you just kind of want to see if it can break through that level, because then you could have a really, really big trade. And look at this one. We'll be closing this one out tonight. We won't look at this one again. There's our triangle on Walgreens. Don't ask me why this chart did this. Take a look at how do you come up with that with all the stuff with COVID and all the things that they've been selling and all the hand sanitizer all over the store. You've been in a Walgreens. I would have thought it would have been an upward breakout. If you were going to pick a direction on Walgreens, wouldn't you have thought, hey, likely to break to the upside? Especially now with all this scuttlebutt about the Delta variant that I brought up, but didn't happen. Massive move to the downside. That's the beauty of the strangle. The volatility, it breaks to the downside. You're good. It doesn't matter. It's fine. So, we'll just go ahead and close that one off. So that one's a good winner. Trading to the downside, even though the market isn't necessarily going down. You got to love that. So I always like to bring this up. When you have these downward breakouts, when the market's actually in pretty good shape, at least I know it's a resistance. I keep commenting about that, and I'm concerned about that resistance personally. I think everybody would agree I'm on record about saying that. But imagine when the market breaks to the downside. If you can get those kind of movements to the downside out of triangles, when the market is good to strong, imagine when the market breaks down, the vertical moves that you get to the downside. That's when it's really fun, and that's coming. And I don't think it's going to be that long. So here was the XLF, and we talked about the yield spreads all over the place. Yields going down somehow, tightening the spreads, making it really difficult for banks and financials to make money. And there you go. So that one came down to 35. So it wasn't quite 10%, bounced up a little bit. And it's coming back down as well. So we'll give that one a little more time. Also, ASAI. And remember the ones that we're looking at now, the reason we're looking at them is because they haven't hit their targets yet. We crossed off a whole slate of them that were winners and hit their targets. Go back and look at the past recordings if you want to see. But really not much going on here. Last week, we rebounded back and just broke into a new high from the entry. Now it looks like we're going to come back down and test 16. So my thought here is that if it can hold 16, give it a chance to break, because that's a big flat that occurred right there. This pattern here looks like it's creating a flat. Well, which way does it go after the C wave of the flat ends? Does it break up or down? Give it an opportunity to break to the upside. But if it breaks 16, then that would be just close that one out and move on. That was when we were looking at for kind of some of the lower dollar momentum stuff. And you saw the IWM is just not performing right now. NVO, and this was back on the 8th of June. And you can see where it was trading. Really nice break to the upside there. It broke back down. It had broken to the upside, came back down, filled this gap. And if the options would just cooperate a little bit, been looking ever since way back here in June for an entry here. We're right back at this resistance level. It looks like we want to take it out and make that run up to 90. Looks like a pretty good 5-point move to the upside. You take a look at the DMI, and the question is, can that positive directional indicator break up again? The ADX doesn't usually do sideways waves like that. That's not quite normal for it. Usually you see it moving either to the upside or the downside, but it's trying. It's hanging in there with the rhythm of the stock, if you will, the wave pattern, pun intended. And then if we get the positive directional indicator to move back, that could be a signal that we are ready to break that resistance and move higher. But that one's looking good. And then Google, I already went through Google. So, what we sent, I don't know what, if you all were looking at it, what you might have done. I just wanted to share with you what we did with the out of the money butterfly. And hopefully you're doing well over the last couple of days also. So how much do you want to make on that? We're going to give it a little bit longer and let it try to creep at least closer to the wings of the butterfly. It's certainly nice to be over a 50% gain when you're 300 points away from the bottom wing. Again, the beauty of the out of the money butterfly. So this was back on the 15th of June. So this is VET, another one of those low dollar ones. So probably not going so well. It's going fine until today. But when you looked at this, you can see why. Triangle pattern. So what would have been encouraging is, hey, maybe we need to morph that. I use that word a lot. Kids were into Mighty Morphin Power Rangers. I don't know. I guess I just got that stuck in my mind over the over my life. But it turned into a really well-formed symmetrical triangle. So converting that from a long position into a strangle would have made a lot of sense with that position. Now, Elliott would have looked at this and said, the likelihood is this breaks to the upside. Now, I'm not trying to say that I'm smarter than Elliott, because I'm not. I know I'm not. I can't make heads or tails out of a tenth of his algorithm. Luckily, we have computer programmers to do that for us, like these people at Hub, which is the computer program that you're looking at right now that create Profit Source. You want to know more about it, it's profitsource.com. You can find out about it. To me, it's the best Elliott Wave software program that exists. I've tried every one that I am aware of. So I try not to say I've tried them all that are out there. I've tried all the ones that I know of that exist. Maybe there's other ones that I'm not, but this one's the best. People like the charts. They're nice and clean. You can create your own searches, etc. You'll see more of it when we're looking for our trade. But Elliott would have said the likelihood is that breaks to the upside because it was in a wave 3. It consolidated into a triangle. The likelihood is it breaks in the direction of the impulse. But what I encourage our alert subscribers, and the way we do it is what we call a trader's approach. And just over the years, I've seen this happen too many times. So I know that by putting on a strangle, you don't make quite as much money as if you got it exactly right on direction. I get it, because we're covering both sides. We can make money whether it goes up or down. So when you widen your potential gain, then obviously something has to give, and it's the total amount of the gain. But you still make money if it breaks to the upside. So if it's in a triangle, it's going to make a breakout. Those two things are rules. Those are going to happen. Why not just, hey, if we make a little less, great. Then we got this covered in a position like this. So it's a perfect example. This one's a perfect example of why I feel that even when you have a triangle within an impulse wave and Elliott says it's likely to break in the direction of that impulse, what's it hurt other than just a little bit of profit potential to cover both sides? I think it makes a lot of sense. So here's MMC back on the 15th of June, and you can see it dipped down. Now we're profitable here. So if we go back, let's see what was the price, 140, trading at 142. Been trading there for a couple of days. So that one looked rough. That looked like that one was going to be a loser at one point, but it's turned around and rallied back. Looks great now. And then Autodesk, now you can see this triangle pattern back on the 22nd of June, and pretty large triangle there. We actually did send this out as an alert to our subscribers, and you can see, boom, pretty significant breakout so far. Gave some back today, but just a little bit, less than a 1% move lower. And so we look at the 10-day moving average. There you go. Got a little bit overbought, so it came back down with the market to correct that overbought condition. But we've moved from where we were at 283 or 4, and we're now up at 295. So not quite a 10% move out of that one yet, but pretty doggone nice breakout there. Boyd Gaming, and another nice triangle pattern. You could kind of create this one a couple different ways. You could make a case for it being a symmetrical, more of a symmetrical triangle, or recently, I think you could argue that no, it's a descending triangle. Either way, it's a triangle. To me, it doesn't really matter. If I had to pick my favorite, it's when a stock runs up and then consolidates into a symmetrical triangle. To me, those just seem to break quicker and cleaner. But all the triangles break out, so it doesn't really matter. So we've broken out a little bit and come back down, and maybe this just is more of an argument for, yeah, it's a descending triangle. Looks like that one's maybe not quite ready to break yet. It's back down towards support, or maybe that's the start of a break, and we see what happens over the next couple of trading days. Then big lots on the 29th. So that was last week, and was pretty determined that we were going to find, we had slipped on, we were doing almost only strangles, and then we did a couple of those directional ones, and Google, a couple of them have worked out well, but feel a lot better with the strangles with where the market is. And then we can see from that looks like a breakout day today to the downside. So the question will be, will there be follow through? And I know if you're looking at it, you could say, well, wait a minute, wasn't Friday a breakout day and this the confirmation day? I just don't think that's enough of a move that occurred on, because you could easily change this line, right, and draw it here through there to where it's really even less of a breakdown. So I just feel like what Friday's move was a move lower, but not enough to count as a breakout day. I think today's the breakout day, and then we'll see what happens moving forward from there. And so that's up to date. Now let's go ahead and see if we can find something for today. And here's one of the things that I was talking about with the software. You click on pre-computed list, and it just brings up a bunch of potential stocks to look at. And over here, if you're one of our alert subscribers, the people at Hub created this. So you have to be an Elliott Wave Option alert subscriber and have Profit Source to get this. But these EWO searches, those are mine. Those are what I've programmed over the years. That's how I select the alerts for our alert service. So you can follow right along and use that as a learning tool too, and look at the same exact charts to look at daily. And so we have subscribers that send them in and ask questions about them all the time. And then there's a few other ones that you might find useful, or at least the folks at Hub thought you might find useful. They kind of play into the things that we talk about. And so we look down here, and now this is interesting to me. I'm just going to take a look at this real quick, but we're likely not going to pick one of these. But if it was a good looking chart, maybe we would consider it. But this momentum scan, this is those lower dollar stocks. Now it's less appealing, right? I mean, you look at, okay, well, the market's moved to the upside and has some momentum, makes sense. Let's find one of these. But where's the IWM? So the whole sector of the smaller caps is not in favor right now. So if we take a look at this and potentially go to, I don't know, that's the only one that looks interesting to me. I don't know much about this stock. That's not the kind of pattern that you really want to see. We have a thing called the launchpad effect. We live on the Space Coast in Florida. And so when a stock goes really sideways, quite often it will blast off like that. But this is more like of a descending triangle that broke out rather than the launchpad type thing. So take a look, and then here's the descending part of the triangle, and then the vertical move higher. But I don't know. That doesn't look that interesting to me anyway. The DMI is not good. Just was curious to see what was there. Not too big of a fan of these ETFs or REITs or anything along those lines. Nuville Real Estate Income, short. Maybe we can look at this one. EVG. See, those things those aren't exciting at all. So that's enough of that. So let's go back, and now what we can do here is take a look at the consolidating stocks. Look at that, 141, even with the movement that occurred Friday, Thursday and Friday. And then today, you have to count today as a volatile move. As well, but still 141 in consolidation pattern. So that's definitely where we want to go to look, see if we can find a good triangle pattern for a strangle. And then we can go look at bullish wave 3. So this is one of the things that's really cool about this. 141, who wants to look at 141 charts? You could, but we can narrow it down. So if we put a check mark in this bullish wave 3, now what the software does is says which stocks are consolidating and are in a bullish or upward wave 3. So now all of a sudden we have 12 or so to look at. And still a lot of these ETFs, Evertech, Luminex. Lots of ETFs. Look at that. Lots of bond stuff. Wow. Man. Bonds are getting ready to do something. Holy cow. And the reason I say that, our subscribers are aware of this. We talk about it all the time, that if you want to be a good equities trader, if you're kind of new to the world of trading equities or trading derivatives, which is what options are on equities, I encourage you to get at least a working knowledge of the bond market. I'm not saying become a good bond trader or anything along those lines, but just have a good working knowledge of the bond market, because it significantly affects the equities markets for a couple of main reasons. One, there's more money in the bond market than there is in the equities market. So it's bigger. So it's big brother. And then on top of that, there's really smart people in the bond market that they know what they're doing. And part of that's because they work on razor thin margins. I mean, you ever looked at a bond chart? They hardly move, and they've got to figure that out and make money off of that. And so they're really smart guys in there. So now when we're looking at all of these bond ETFs that are in consolidation patterns, they're probably licking their chops. Hey, we're going to get some volatility in bonds. Well, equity traders are like, whoa, we're going to get some volatility in the bond market. So you guys have an entirely different dynamic there. They're excited, and we're leery of which way is it going to go and what's it going to do, because there's negatives to a significant move in bonds, whether it goes up or down, right? If interest rates go up too fast, that's bad because that affects corporate profits. And the shrinking profits is going to shrink stock prices, obviously. Well, if it moves to the downside, that hurts the financials. And if the financials are getting hurt significantly, can you really have a strong market expected to continue to the upside without the leadership of the financials? And is that telling us that maybe there's weakness coming in the economy, et cetera? So you can see that what the equities market likes is when bonds do nothing. When bonds are just kind of stagnant, they just drift around. That's what equity traders want. They really get nervous when bonds make a significant move either direction. So a quiet bond market is an equity trader's friend. Doesn't look like we're about to have that. So here again, playing into why we've been, even with this upward break in the market, really focused on the strangle positions. So let's just take a look at a couple of them that aren't bond ETFs. So that's obviously a consolidation pattern. That one was a buyout. So that stock got acquired. That's what that means. When you see a sideways chart like that, they've been bought out. They just haven't been delisted yet or absorbed yet. Maybe it hasn't been official or whatever, or become official, you try to say. So that doesn't mean anything. So let's go look at EVTC. And what I like to look here is how low is that ADX? The ADX is one of our chief indicators to telling us not that a stock's in a triangle pattern. Stocks can be in triangle patterns with high ADXs, but a very low ADX tells you that the stock has likely been consolidating for a while and probably getting ready to break out. So it's near the breakout point. So when we look at that, diving down there, I really like it when it gets down to 13, and that's pretty darn close there, right at 13. Now, it's not really much of a triangle pattern, though, is it? And so this becomes an issue. The last thing that you want when you're trading strangles is for the stock to go sideways. We're good if it goes up. We're good if it goes down. The one thing that we don't want is for it to go sideways. That's where the risk comes in, right? There's always some risk in a position. So, breaking to the upside or breaking to the downside and being able to profit, that's wonderful. Just don't go sideways. Just go somewhere. We don't care where. Just move. Well, that one really isn't. So even though the ADX was low and it looked good, that's really not much of a triangle pattern, if anything. And I've talked about this in the past. I've seen more of these this year. So it would be a year and a half now. I mentioned that last year as well, than I can ever remember in that condensed of a time frame. Expanding triangles, the exact opposite of what a normal triangle looks like. Now the point's on the left side and the mouse over on the wide side, on the right side. And you can see that it was far less volatile here over on the left in the point, and the bars are more volatile here. So you can make a case for it being an expanding triangle and say, hey, why don't we do it anyway? And that's a valid argument. Just for the heck of it, let's see what the options look like. So EVTC, see if we have any significant options. Not super familiar with it, so there we go. Come on. Well, the internet is not the greatest up here in the mountains, and so it does look like it's on the NYSE. It's not the chart of EVTC. Obviously, that's Google. That was in there before. So we'll see if come back to it. Yeah, it's still showing the Google prices. All right, we'll come back and see what happens with EVTC. It was on the Amex too. It's on multiple exchanges. Well, okay.
Sorry to
Back
interrupt.
over.
Might be
What's that?
just wanted to remind you of the charts that could be interfering with regards to how fast the software is moving.
Yeah, that and Mountain Internet. Thank you for the reminder. So what Zach was reminding me on is just like your computer has limited virtual memory, so does the software program. I mean, it's analyzing a lot of stuff. So there's a limit, like when your computer's open, if you have 1,000 windows open, your computer just stops working, right? Because the virtual memory's gone. It's the same exact thing here. If you have too many charts open, it's just too much data, and it'll tend to freeze. So that could have had something to do with it. Anyway, let's go back to yeah, that one's interesting. I'll say, I wonder what the consensus was be on trying to find one of these bonds. If I was going to do anything, I would do height. Jeez, what that was. I would do high yield, but let's try this. We had good success out of this before, so now I'm going to uncheck the bullish wave 3 and go to bearish wave. Oh, we got another one. Dave & Buster's. How about that? Have you ever been to one of those? They have them in Orlando. I don't know if there's anywhere else. It's a big, huge restaurant with games in it and stuff. It's like a big amusement park almost inside. So it's kind of a bit of a breakout today. So let's see if that's too much. You can see that we got a little bit of a move up on the ADX too, and it gotten down below, even below 12, maybe even below 11, right around there. So that was pretty low. It's ready to do something. And it was a nice descending triangle pattern. But I think that looks pretty significantly like a breakout day there. It did close well off the lows. But that's a big triangle, the mouth of that descending triangle. So let's call it 40 for support and 50 as far as the top end of so what we're measuring is the high and the low and the mouth of the triangle, because that's your rough breakout move. And so that would be a 10-point move forecast on $40 stock. We're usually talking about a 10% move, and that's over 20. So I think that's going to be our winner there. So we're going to go ahead and put that one down as our case study consideration for this week. So PLAY for Dave & Buster's. And hope that it doesn't open significantly to the downside in the morning, because I think it's kind of breaking out a little bit. So the question would be, if you were going to set up a strangle here, would you change the delta on the put because it's broken? I don't think it's moved enough, and the size of the movement is so large. That's why we're kind of saying, okay, even though this could be a downward day, it's only broken maybe 1 point of the 20-point potential, and the fact that it closed well off the lows, maybe that's a little head fake and it comes back and breaks to the upside in the end. Who knows? But with Walgreens and everything else, and certainly you consider the fact that this needs people to come to it, and if we start talking about that Delta variant, etc., then maybe starts looking like a downward breakout move. There's not a whole lot of resistance on the way down. As you can see, there's some consolidation right in there, not much there. Other than that, there's really not a lot. So that could be a pretty good move lower because of that big move to the upside. So pretty nice run up, not really a symmetrical triangle, definitely a descending triangle, but a pattern that looks like it can move. So I like that. All right, so we've got a few minutes left. If any of you have some questions or stock symbols that you'd like us to look at, we'll take a look at a few of those before we wrap things up.
Alrighty, just thought we'd start out by first, Constantine and Steve both wanted to wish you a happy birthday, so wanted to pass that.
Oh, thank you guys. Appreciate that very much. Kind of getting to the point where I don't really like celebrating those things anymore, but they come every year whether you want them to or not. So yeah, I appreciate it very much. Thank you.
Alrighty, so the next question will be from Randall, and it'll be Uber Strangle.
Uber. So if you're wondering what does it mean when it says like it's on multiple exchanges, sometimes it's on international and the US, but on the US it's a ADR, American Depository Receipt. But often that means that it was trading on one exchange at one point in time and moved to another one, like it was on the NYSE. And so there was data there, and then the stock moved over to the NASDAQ or something along those lines. So go on and why it says that. That's the reason why. Yeah, I mean, it's not the greatest triangle pattern, but 50 is, you know, it's hard to argue with the importance of the 50 level. So I can see where the question is, or what the question's referring to. And the ADX, I think we've looked at this before, if I remember, but I could be mistaken. The ADX is diving down. This is a good example of why we like the low ADX, because see how long this has gone sideways. So it's been consolidating for a while, and we were thinking it should be ready to go. That's getting pretty close to the launchpad effect. And by the way, the launchpad effect, it normally breaks to the upside, but it can break to the downside too. But it's usually a pretty vertical move that comes out of that real sideways consolidation. But the fact that the ADX was higher and it's consolidated, and the ADX has continued lower. So if we take that potential out of our strangles, because now we have time decay on both the long call and the long put, right? So we're covering both sides on the directional breakout. So time decay is an even more concern. And that's why, all right, what can we do to offset that? Well, let's find an indicator that tells us about when the stock's ready to break out. So we don't have to sit there and twiddle our thumbs. Sometimes stocks still take a while. Sometimes they form bigger triangles. You know, nothing's absolute, nothing's 100%, but we can whittle a lot of that out by having an indicator that tells us when the stock's about ready to break out. And that's a very low ADX. That's what we utilize. So taking a look at that, you can see that the ADX it's coming down now. I still would like to see it get below 15. Maybe it needs to do that, but 50 is definitely, this sounds terrible, the line in the sand, but it's amazing the way it trades around $50 a share. I mean, that's almost unusual, the way it's hugged that line. So maybe if the ADX can just get down a little bit lower, it might have something there. But yeah, it's going to break at some point. It just doesn't go. Stocks don't do that forever. Okay.
All right, a couple more from Pankaj. Can you please cover PLTR and Baidu? So I believe you already covered PLTR. But...
no, this is Palantir. So Palantir, excuse me. You're thinking of PLT, I think, Zach, which was Plantronics.
Right.
So easy to get those confused. When you look at PLTR, you can see that. Whoa, 25 is to this one is not quite as much, but 50 is to Uber. So this is in a 5-wave to the downside pattern, but 25 is what it has to break. If it breaks that, then man, it could be moving significantly lower. But 25 could hold. You can see how it's been support resistance going all the way back to this triangle that it formed back at the end of last year, where it had run up as most things did, after COVID, but this one was a new issue at the time. You can see it started trading at the end of September. Ran up. There's the pattern that I'm talking about. Run up, consolidating triangle, false breakout to the downside, ran up again, and then came back down, but boom, off 25, boom, broke it, back above it, broke it, tried to break above it, couldn't hold it. It's been trading below it ever since, just recently broke it at the end of June where it broke above it. Maybe it's just testing that level right now of 25, and then it takes off to the upside. But if it breaks 25, I think there's a good chance based on this pattern that you're probably going to go down to that wave 5 target. But it's got to break 25 first. It could hold there. Let's look at the DMI. Not getting much of a signal there. So yeah, it's telling you that the support level there could possibly hold. That's it. 25 is what matters. It bounces up off of it, then it probably relabels this pattern. If it breaks below it, then watch out. And what was the other one? I'm sorry, I forgot the other symbol.
Baidu. BIDU.
Oh, Baidu. Man, this Chinese government just is getting more and more involved in it. So I don't, sorry, I put an extra character in there. It's concerning for trading Baba, Baidu, Neo, all the ones that people are used to, when they're just putting more and more regulations and coming after companies that have done well. And it's just, they are taking a big step back from democracy, that's for sure. I mean, I know they don't have democracy, but it seemed like they were kind of wavering and more of a public, more entrepreneurship, more successful businesses. It's kind of seemed to be evolving, and now it's like they've stomped it down and said, no, we're not, that's not it. We're going back to our old ways. That's really what it feels like. And with all this regulation, I mean, it's just the stock rolled over because of that. And that's the concern, is the government is just rattling their sabers. And then they just came out with that news in this past week. And that's why the stock rolled over. It had made a nice break off of that support there, consolidated for a while, and it broke above these highs that had occurred back at the end of May, early June. So it looked like it was ready to go. It was ready to tackle 220. It just needed to get above 220, and then it was off to the races. Well, now it needs to hold down here near 180 because of all that stuff that's going on. And I don't know, if they just keep throwing stuff, the Chinese government. So I don't know if it can hold it. They may all make significant breakdowns. And if that one breaks, then it's easy to see where it's going. It's going to 140. If it can't hold 180, it's going to 140. There's nothing wrong with the business model. They make tons of money. But it doesn't matter if the Chinese government's going to come in and restrict their business practices and restrict the potential profitability, then it matters. But anyway, so those are the levels there. I'll stop babbling on so much so we can cover more charts with another one.
All right. Just wanted to remind those watching from YouTube to hit that like button if they've enjoyed the webinar so far. But next question will be from Cindy. For the SPY, there's a gap around 402. Do you think we fill that gap? Thanks.
I do think we fill that gap, and I feel pretty confident that we will. Now, the question becomes when, right? That's always the million-dollar question regarding when gaps get filled. I've talked about this gap myself before. I do think that gets filled. I don't know when. I'm a bit surprised that, well, we did have the one other zigzag target up here. I'm a little bit surprised that we've broken to the upside. I felt that if we did break to the upside, it'd be a pretty volatile move. It was. Even though I'm surprised it happened, and figured if it did, that would have to be it, because there's a lot of stops right there that had to be unwound. We'll see what happens tomorrow. That was a pretty good 2 days. So could that have been a head fake to the upside? Maybe, but the 2 days were pretty strong. And then we come back here and we can see that this level here at 400, a big round number, that gap, I feel pretty confident is going to get filled. But how much higher do we go first before we reverse back down? That to me is where the stickiness comes in. I don't know. You trade what the charts tell you. My personal opinion, which is worth nothing, is that we don't hit the 261.8% level, but we might. It's there for a reason.
All right, next up will be from Charlie. TNX and banks going down, recession.
Yeah, I'm with you, Charlie. I mean, just look at that. That's scary. I can tell you the equities market doesn't want this. So, we covered the overbought condition today. So we've rectified that. Kind of a bit surprising with that breakdown. I guess yields aren't low enough yet to where it's concerning big equities traders as far as exactly what you brought up. Some sort of a recession coming. I don't think it's a good sign when rates go down like that. It's definitely bad for financials because they can't make any money. They're barely making any money now. And they were finally got a little bit of a spread. They were finally got an opportunity to make some money on that 210 spread and mortgages, et cetera, with a little bit of bump in the rates. Now it's right back down and they're getting handcuffed again. So that was my point earlier is how far can the market go without the financials? Historically, not very far. Historically, the financials have needed to be involved.
Next up will be from Scott. QQQ is overday. RSI shows overbought. Correction?
Well, maybe it came in a little bit late. We did look at the Qs early, right when we first started. I talked about the Qs. I looked at the DMI, not the RSI. I'm more of a DMI fan than RSI, but the interesting thing is they're both created by the same guy, Wells Wilder. We can take a look at RSI. So you can add that on there if you want. And you're correct that it's showing definitely overbought here on the RSI. You can see breaking above the trend channel there. But when you look at the DMI, it looks like there's still room to go. If you're not as familiar with the DMI, the ADX, once it moves to 40, that's where it's considered to be overbought. So there's room there. So he created both these indicators and they're kind of giving us slightly different signals. So that's interesting as well. I have looked, and this is just my personal preference. I've looked at both of them. I've traded with both of them. I've put both of them into technical systems. And it's just my personal preference that I like the DMI better over the long run. That doesn't mean that it's right every time. As we know, nothing is right every time. But just that's been my personal preference. And the DMI shows that we could go a little further in the movement. So that's the SPY. Back onto the Qs. With that, look right there. So I don't know. Interesting. We'll see.
All right. Pass a couple through more to you, depending on how many you'd like to take.
I'll take two more because we're past an hour and 15 minutes now. So.
Alrighty. So Van said fake news. I'm guessing that's in regards to the Delta variant section when you were covering that. But he also sent in BLIN.
I'm sorry, one more time.
The symbol he sent in was BLIN, B as in Bob.
Okay, BLIN. Bridgeline Digital. Oh, okay, that's fine. The guys come up with these symbols, and I'm not familiar with these lower dollar ones. Well, that's a to the moon one, right? I mean, that's came out of nowhere. I don't know what the news was that sent that stock higher. The problem with this is we don't really have any indicators that can I don't think there are any indicators that can take a look at that and give you an idea of where it's going to go when it's traded at $2 or $3 forever, and now it's at 15, and just rocketing up within a few days. It just throws all the technical indicators out of whack. So the only thing that I can rely on, or what I rely on when you see that, is the 10-day moving average, and how far from it can it get. Well, you can see that it can get a ways, because it is severely overbought from the 10-day moving average. That'll correct itself, but I don't know that it doesn't go higher first. There is an Elliott wave target there around 17.5, which will probably get hit at some point. But does it come back down and fill this gap and let the 10-day moving average catch? Does it run straight up there and then come back and correct? Stocks can stay overbought, oversold for a period of time. It's just not a long period of time. So I'm sorry. I'm not the guy to tell you where I have no idea where that could go. If you're in it, if you're long, congratulations, and glad you made a great trade. But from here, I have no idea where it could go. That was a heck of a move.
All right, and if you want to finish on this last one from James, so can Rob show the risk graph for the Google butterfly? A picture would be better than all the commentary.
Well, that wasn't very nice. You know what? I will bring up and show. I'll set the trade up and show the risk graph next week, and we'll get an idea. I'll set it up. I'll take a picture of it from when it was originally set up. So that'll take me a little time to go back and use the dates that it was set up and create the risk graph of what it looked like then, and then show you next week where it has and where it's progressed. I'm going to make a note of that so I don't forget. That would be something interesting to see, but you'll be pretty amazed at the curve on where the profit can go based on the cost going in on one of these out of the money butterflies. It's pretty amazing. So we'll spend a little time on that next week. So Google risk graph. All right. Well, I mean, the commentary, I think you need to understand the strategy and the idea behind it, and then the risk graph. Remember, risk graph's a finite period of time, and it's changing in a finite period of time, even though you have lines, you have timelines in between, but it's drawn at expiration. The odds of us holding it to expiration are very slim, almost none, but it gives you a general idea. So I don't show risk graphs as much as I used to anymore for those reasons, but just to give everyone an idea of what the position looks like, I think it makes sense. So I'll go ahead and do that. All right. Thanks, everybody. As always, appreciate it. If you were new, hope you enjoyed it, and I look forward to talking to you.